The global economy often looks strongest right after something painful happens. A market falls, weak companies fail, credit gets tighter, hiring slows, and policymakers call that progress. That sounds backwards until you stop thinking of the economy as a machine that should run smoothly forever. It is closer to a living system under constant pressure, one that stays alive not by avoiding stress, but by shedding it before it becomes fatal. Falling asset prices, tighter lending, and failed firms can prevent a buildup of bad loans, inflated valuations, and unrealistic expectations from tearing through the whole system later. Most people are taught to equate stability with safety, but stability and resilience are not the same thing. A system can look calm for years and still be getting weaker underneath, the way a bridge can look solid while metal fatigue spreads through the joints. In markets, long stretches of low volatility often encourage people to borrow more, take more risk, and assume central banks will step in if trouble starts. That pattern suppresses visible swings in prices while increasing leverage, concentration, and dependence on cheap funding. When a shock finally arrives, it hits banks, funds, and companies that have too little cash, too much debt, and too much faith that refinancing will stay easy. Modern economies operate through controlled instability. Not controlled in the sense that anyone is fully in charge, and not instability in the sense of chaos for its own sake. Pressure moves from one sector to another, gets released through losses and defaults, and is limited by partial, improvised interventions. Prices need to move, bad bets need to be exposed, weak firms need to lose access to easy money, and expectations need to be reset before fantasy hardens into balance sheet reality. If policymakers, lenders, and investors suppress falling prices, defaults, and tighter credit for too long, they usually store up a larger credit break, deeper recession, or more violent repricing later. A simple way to see this is through debt. Credit expansion is one of the main engines of growth because it pulls future demand into the present. Households buy homes, companies invest, private equity uses leverage, governments spend before tax revenue arrives, and asset prices rise because more money is chasing them. That growth is real in the short run, but the risk is real too, because debt creates fixed payment claims on future income. The future has to deliver enough income to validate the borrowing, and when it does not, the pressure returns all at once. Low interest rates make this process feel painless at first. Cheap money lowers monthly payments, lifts valuations, rewards long-duration assets, and tells investors that risk is affordable. It can also push people into behavior they would never choose under normal conditions, like buying homes at stretched prices, funding companies with no path to profit, or rolling over debt that only works if rates stay low. For a period, rising home prices, strong stock multiples, easy refinancing, and steady hiring can all resemble durable prosperity. Then rates rise, refinancing windows narrow, bond prices fall, equity valuations compress, and borrowers learn that assets they treated as liquid can only be sold easily when credit is abundant. Repricing is one of the economy's core adjustment mechanisms. Prices are not just numbers on screens. They are signals about risk, scarcity, confidence, and expected cash flow. When optimism runs too far ahead of reality, prices stop telling the truth. A correction forces the truth back into the system by lowering valuations, widening credit spreads, and making capital more selective. A correction can mean lower stock multiples, wider junk bond spreads, lower commercial property values, and stricter lending terms, all of which help markets discover what assets can earn and what borrowers can actually repay under current rates and demand. There is a big difference between a correction and a systemic crisis. A correction is when losses stay mostly where they belong and the system keeps clearing. A systemic crisis is when losses threaten payment chains, collateral values, bank funding, or sovereign borrowing, and fear itself starts changing behavior fast enough to make the problem bigger. Central banks watch for stress in repo markets, bank funding, treasury trading, commercial paper, and payment systems. They can tolerate falling asset prices much more easily than they can tolerate a seizure in plumbing. Because once liquidity freezes, even solvent institutions can fail from timing alone. Liquidity and solvency sound similar, but they are different problems. Liquidity means you cannot get cash right now, even if your assets may still be worth more than your liabilities over time. Solvency means the assets are simply not enough, and no amount of temporary funding fixes that. In a panic, those two get mixed together because falling prices make balance sheets look worse. Lenders pull back, and a funding problem can become an insolvency problem through forced selling. That is why central banks step in during crises, to keep margin calls, frozen short-term funding, and fire sales from turning temporary mark-to-market losses into bank failures, money market runs, or broken payment chains. In 2008, this dynamic was impossible to miss. Years of cheap credit, housing speculation, securitized debt, and faith in rising home prices built a structure that looked stable because defaults stayed low and funding stayed abundant. But that calm depended on collateral values continuing to rise and short-term funding continuing to roll. Once home prices fell and mortgage losses spread through the financial system, the issue was no longer one bad sector. Core funding markets seized up, banks doubted each other's collateral, and officials responded with rescues and emergency liquidity because they feared an uncontrollable chain reaction through the financial system. Those rescues came with a cost that never fully goes away. When markets learn that severe losses may trigger intervention, risk-taking can increase the next time around. Markets call that moral hazard. Investors and lenders take bigger risks when they expect central banks or governments to absorb the worst tail losses. Save the system, and you reduce immediate pain while teaching investors that tail risk may be socialized. Refuse to save the system, and you may preserve discipline while allowing a collapse that destroys far more than the original excess. Policymakers do not get clean choices. They get ugly trade-offs between pain now and panic later. Inflation creates a similar double effect in debt-heavy economies. People experience it directly as shrinking purchasing power, more expensive food, rent, fuel, and a sense that the ground is moving under their feet. But inflation also reduces the real burden of existing debt, which matters in a world built on borrowing. If wages and nominal incomes rise while old debts stay fixed in dollars, some debt stress gets quietly diluted. That can ease pressure on borrowers with fixed-rate debt and improve nominal tax revenues, even as households facing higher grocery rent and energy bills feel the loss immediately. During COVID, this logic played out at high speed. Governments sent income support, central banks cut rates, and bought assets, and liquidity flooded through economies that had been deliberately shut down. That prevented a depression and stabilized employment and finance during an extraordinary stop. It also collided later with supply constraints, labor shortages, energy shocks, and demand that had been pulled forward, producing inflation that was much harder to contain than many expected. The emergency support prevented a collapse in incomes and credit in 2020, then contributed to an economy in 2021 and 2022, where demand recovered faster than supply could respond. Then came the 2022 rate hike shock. Central banks had to reassert credibility on inflation, even though higher rates would hit housing, tech valuations, venture funding, government financing costs, and heavily indebted firms. In effect, they accepted pain in asset prices and growth to defend the currency and prevent inflation expectations from drifting upward. Central banks accepted falling home sales, lower stock valuations, and weaker borrowing in order to protect confidence that money would hold its value. If people stop believing the value of money will be defended, the damage spreads far beyond a bear market. Recessions fit into this framework in an uncomfortable way. Should romanticize unemployment or bankruptcies. But recessions do clear things that expansions hide. They expose bad debt, shut down projects that only worked under fantasy assumptions, force lenders to care about credit quality again, and remind investors that price matters. After long stretches of cheap money and rising asset prices, recessions often force overbuilt sectors to shrink, wipe out weak business models, and push lenders to recognize losses they delayed. Suppressing every small failure is like putting out every small forest fire until dry fuel covers the ground and the next fire becomes a wall of heat. Soft landings are rare. Getting inflation down without cracking credit markets, freezing hiring, or forcing large deleveraging is an extremely narrow policy path. Expectations feed directly into behavior. If firms expect weaker demand, they cut orders, investment, and hiring. If banks expect defaults, they tighten lending. If households expect inflation, they change spending and wage demands. If firms expect weaker demand, they cut investment and hiring, which weakens demand. If banks expect losses, they tighten lending, which produces more losses. Efforts to slow the economy gradually often change borrowing, pricing, and hiring decisions in ways that make a gradual slowdown harder to achieve. Global interdependence makes this process harder to contain. Supply chains stretch across oceans. Energy prices feed into everything. Sovereign debt markets affect currencies, and one country's rate decision can tighten financial conditions for dozens of others. A banking scare in one region can push capital into dollars, which raises pressure on countries that borrowed in dollars. A war can move food and fuel prices, which then hits inflation, politics, and bond markets far away. Shocks rarely stay in one country or one market. They pass through trade flows, commodity prices, exchange rates, and cross-border funding markets, instead of disappearing. So who benefits from this arrangement? In the short run, large institutions close to credit creation often benefit because they can refinance, hedge, and survive volatility better than households or small firms. Governments benefit from systems that can absorb debt through inflation, growth, or financial repression rather than outright default. Investors who understand the cycle can benefit from repricing that wipes out weaker hands. Periodic defaults, markdowns, layoffs, and tighter lending can keep a debt-based system flexible enough to keep operating. Because without those release valves, too many promises would remain priced as if growth, income, and asset values could never disappoint. The global economy does not eliminate instability. It shifts it through time, across sectors, and onto different groups. It runs by moving instability through time, across sectors, and between social groups, trying to keep local damage from becoming total failure. That is why monetary policy, bailouts, and market moves often send mixed signals at the same time. The same rate cut that saves jobs can feed a bubble. The same rate hike that restores monetary credibility can crush housing. The same bailout that prevents collapse can plant the seed of the next excess. Seen this way, the system looks less like a machine seeking permanent calm and more like a structure that relies on contained losses, recurring repricing, and occasional small fires to avoid a much larger one.